Have Gurmeet Chadha with us from Complete Circle. Also, Manish Sonthalia, CIO at MK Investment Managers, is joining into the conversation. Welcome to the show, Manish. Good to have you on as always. Let me start with the basics. What have you made of the earnings season so far? The upgrade to downgrade ratio, etc. Have you started looking at that kind of an analysis? And then, therefore, what's the report card saying?
Except for oil and gas and metals, the earnings growth so far, or just about 3 or 4 days back, was around a 15% sort of an earnings growth, which to my mind is all right, given that the overall earnings expectation for this quarter was just about 5 to 6% on a YOY basis. So in that backdrop, I would believe that few sectoral disappointments, which was quite expected, was IT. It was muted set of numbers. Banking results have been good, both from private sector as well as the public sector so far. You could say that deposit accretion for the private sector, which came in as a positive surprise, could have some element of cyclicality, which is normally the case for Q4. And we'll have to see the continuity of the deposit growth accretion going into the first quarter. If that happens, then obviously the results would reflect in the market cap also for private sector banks. But otherwise, I think pharma has been good. Metals and oil and gas was expected to be somewhat on the negative side. All in all, I would believe that numbers are at par, in line with expectation, nothing to be too disappointed about.
Manish, afternoon. What about the impact of the elections this time? There appears to be some nervousness which has crept in over the last couple of days. The FIs are selling in the market. Is it time to maybe increase the cash in the portfolio or just sit tight, ride it through? Any changes in the portfolio composition because of the election cycle? How are you going to assess the impact of the elections?
I think the best strategy is to get fully deployed. And as is the case with every election, you start with a very positive number on whatever the expectation is. So the NDA started with a 400 sort of a seat. Phase 3, it comes down to that they are not going to get even 272. And, as we approach the 6th phase or the 7th phase, you could end up being, somewhere in the region of 330 or 350. As long as the number is more than 272, I think the markets would read it very positively. And a whole lot of money sitting on the sidelines waiting to get deployed to see the new government. So in that backdrop, I would believe that I'm not negative at all. In fact, you would use all the weakness in the markets to either, get more subscription into your funds, or if you have funds, to get it fully deployed.
Okay. Hi, Manish. Good afternoon. Good to see you. When fully deploy, that's the way to look at it. And, I think the point you make is very important because the ruling BJP will definitely get a majority, going by what we're expecting. So deploy and, buy stocks that you like. What about the auto space? You just had Hero MotoCorp's numbers that came in a few minutes ago. And that stock is surging away. It has some valuation comfort as well. It's been a bit of an underperformer in comparison to its peers. How are you all positioned on the auto space, particularly the two-wheelers?
So two-wheelers is a positive stance as opposed to four-wheelers. But it's not a comment specific on Hero MotoCorp, but I would believe that, the premium segment of the two-wheeler space, which is basically 350cc to 500cc, that segment of the market is actually growing at 70-80% vis-a-vis the overall growth.
Good afternoon, Manish and Gurmeet. Gurmeet, what have you added to the Complete Circle portfolio from the last time we spoke? Give us some, give us a sense.
So a couple of things, Prashant. We've been a believer of buying on dips. I agree with Manish on a point that you should not take extreme calls on the portfolio because things we are not certain of. We should not try and beg big money. That's not the rule of investing. We are doing a bit of a rebalancing. I think small mid caps had a stellar rally, especially in defense, especially in few segments of PSUs where we made a lot of money. Some auto ancillary stocks. So it's just a bit of rebalancing it, not really exiting it. And maybe keeping some powder dry. It helps in volatility in terms of leading up to election. We've added few companies. One company we've added is in waste management, which is Ganesha Ecosphere. Government has come with a clear guideline of using 30% recycled content in a lot of categories, including PET bottles, including MDPE, where the drums, etc. are made. So it's a bit of a regulatory opportunity. So the demand is, let's say, 5 lakh tons for, let's say, something like rPET, and the industry capacity is pretty low. So we've added Ganesha Ecosphere in that space. We've been adding some auto ancillaries on dips. We believe that especially the ones which are playing the premiumization and content per vehicle theme, includes Sandhar, includes bit of Uno Minda, Sona BLW. We've been buying them basically on dips. Adding more market infrastructure plays like CAMS, CDSL, etc. on dips. Of late haven't added because the stocks have run up quite a bit, but we did add when we got 1600 levels to CDSL. And we are adding some banks. We believe that with treasury gains coming in June with bond inclusion, I think banks are, and very reasonably priced. Most banks today are getting at 2.5 book value in private space, and a lot of PSU banks are around 1 book value. So my sense is that leg is where the EPS growth will be maximum over the next 2 quarters. And I think that's what we're trying to add in the portfolio.
You know, for your clients, Gurmeet, the NSE recently gave out a bonus, and there was that dividend as well. And I think arguably they should do about 210, 220 rupees in earnings this year. So it trades at roughly about 20 times. The listed players are at 40, 50. Do you have the mandate to sort of add private companies as well? To recommend and no?
No, not really. You can't do that.
Maybe on the wealth side.
In a PMS, you can't do that.
Of course.
But yeah, we do. I mean, we have been, actually, being honest, we've been selling NSE since 900 levels, to be honest. And I think we've had a really good ride there. And I think it was a no-brainer. As I said, I do the numbers. Prashant, it's very secular. And I think NSE still is pretty reasonable. See how BSE has gone up. But I think one risk there is the regulatory action on derivatives. Our derivative values are 400x to cash. They're talking about increasing trading hours. I think there's a bit of a pushback there. Some regulatory intervention will come with so many expiries and all. That's one risk. So I like depositories and AMCs and RTAs more versus exchanges at this point.
You know, just to comment on this, Prashant, yesterday on Trading Hour, we were discussing exactly this. The fact that at least, the Damocles sword that keeps hanging over our heads, that extension of trading hours, it seems to be sort of off for now. So the view from Asit Mehta, Dina Mehta, as well as HDFC Securities MD Dheeraj really, both were saying that in some ways, I mean, not that it's the only reason, but in some ways it has perhaps a linkage with this whole talk of excessive speculation. So you perhaps want to limit that and then look at a healthier market, if at all. I mean, SEBI wants to push through longer trading hours. I just wanted to put that.
Not more, at least not right now.
But just to bring Manish into this on it, Manish, give us your view, not on the trading hour debate, or maybe that too, if you have a view there, but the fact that market infrastructure stocks and asset managers, wealth managers, I mean, these stocks have really shot through the roof. Now, how much of a runway still exists? Perhaps it's still early days, but then what about valuations? And what kind of multiples are you still comfortable with when whether it's an Angel One or an Obama, or, a lot of the companies are actually your peers as well?
Well, as I've been maintaining that all platform businesses will have non-linear growth. And as far as the financial markets are concerned, there's no better visibility than this sector. So if we talk about, let's say, exchanges that we were dealing with, so it would be very reasonable for a market like India, which is currently at closer to $4 trillion economy, to be at $7.5 trillion economy by 2030. In all probability, your volume levels on stock exchanges are nowhere going to be what they are today. It's going to be much higher. So, I mean, just for some simplicity's sake, you could expect a 10% growth between now and 2030, and even beyond that, because, we are nowhere close to being a developed market just yet. And trading volumes are much higher out there. So a 10% growth till perpetuity, given that cost of capital is 12% and your growth rate at 10%, and that year's cash flows, so it's basically K divided by 1 divided by K minus G. So 1 divided by 12 minus 10, that gives you roughly a 50p. So that year's cash flow into 50p should be a justified valuation. Now, whether it means FY24 that you want to focus, FY25, FY26 is your call. But sitting in FY24, you would look at FY26. So I think the maths just adds up. It's just a rolling figure on the profit numbers, net profit numbers, going into the future. And that would work well for all platformized businesses, particularly when it comes to capital markets, RTAs or depositories, and these are duopoly structures. You can't have enough competition coming in these spaces. And, whether it be do-it-yourself model in the case of broking platforms, or whether it is, let's say, a phygital model, partly digital, partly phygital. I mean, all segments of the market will likely grow because it's a financialization of savings scheme. And in that backdrop, I think wherever is the comfort is where you'll actually be able to park your money.
Okay, all right. Manish as well as Gurmeet, appreciate you joining in and discussing all those stocks and themes with us. Wishing you all